Kevin are sitting in the same break room on a Friday afternoon in March 2019. They both just got their tax refunds. Jordan got $6,200. Kevin got $5,800. They both decided the same week to stop letting that money sit in a savings account, earning nothing, and start investing it in dividend funds. They both wanted passive income. They both did research. They both felt confident walking into it. 5 years later, Jordan is collecting $744 a year in dividends on a portfolio worth $9,100. Kevin is collecting $312 a year on a portfolio worth $8,600. Jordan is bringing in more than double the income. His yield looks incredible on paper, and if you only looked at the income number, you would say Jordan won. But Jordan started with $6,200 and his portfolio is worth $9,100. That is a 47% gain over 5 years in one of the strongest bull markets in American history. Kevin started with $5,800 and his portfolio is worth $8,600. That is a 48% gain, almost identical total return. Except Kevin's portfolio is still growing and his dividend is increasing every year. Jordan's income has been flat for 3 years, and he is starting to notice something he did not see coming when he picked that fund. Let's go back to March 2019 and follow exactly what each of them did, because the decision that separated them took about 4 minutes and felt completely reasonable at the time. Jordan searched for dividend ETFs sorted by yield and picked the one at the top of the list. It was paying 11.4% annually on $6,200. That was $707 a year, coming in monthly. He read the fund description, saw that it held large, well-known companies, saw the yield number, and bought it. He felt like he had found something other people were sleeping on. Kevin did the same search, looked at the same list, and then made one extra click that Jordan did not make. He looked at the 5-year price chart of the fund Jordan chose. The share price in 2014 was $28.41. In 2019, when they were both sitting in that break room, it was $21.17. The fund had been paying a high yield the entire time, while its share price quietly declined 25%. Kevin did the math. If you collect 11% a year, but lose 5% a year in share price, your real return is 6%. And that is before you account for the fact that a shrinking share price means the dollar amount of each dividend payment slowly shrinks too, because the fund is distributing income off a smaller and smaller asset base. Kevin bought SCHD instead. The yield was 3.2%. He felt like he was leaving money on the table. Here's what was actually happening inside Jordan's fund that he did not know to look for. The fund was a covered call ETF. It owned a basket of stocks, and every month it sold options contracts on those stocks, collecting premiums and distributing those premiums to shareholders as income. In a flat or declining market, this is a reasonable strategy. In the bull market that ran from 2019 through 2021, every time the underlying stocks tried to rise significantly, the fund had already sold away the right to participate in those gains. The companies it held went up. The fund did not go up with them. The shareholders collected their monthly checks and watched the portfolio value stay roughly flat while the broader market doubled. Jordan did not lose money. That is the part that makes this trap so effective. He collected real income every month. His statements then showed dividends arriving like clockwork. It felt like the investment was working exactly as advertised. What he did not see was the opportunity cost accumulating invisibly every quarter. The market was handing out 25% years and he was collecting 11% while missing 14%. By 2022, when the market finally pulled back and covered call strategies started outperforming, Jordan had already given up 3 years of gains he could never recover. Kevin's SCHD position told a different story across the same 5 years. The fund raised its dividend in 2019, 2020, 2021, 2022, and 2023 every single year, without a cut, without a freeze, without a restructuring announcement. The yield on his original $5,800 investment climbed from 3.2% to 5.4% on cost by 2024 because both the dividend per share and the share price were growing. His $5,800 became $8,600 in portfolio value and $312 in annual income, which sounds less impressive than Jordan's $744 until you understand that Kevin's $312 is still growing and Jordan's $744 has been flat for 3 years. This is the yield trap in its most common form. A high yield number attracts investors who are optimizing for current income without asking why the yield is that high. There are only a few ways a fund can pay 10, 11, or 12% annually. It can hold extremely high-risk assets like junk bonds or distressed debt, where the yield reflects the probability of default. It can sell options and cap its own upside the way Jordan's fund did, or it can distribute return of capital, which is exactly what it sounds like. It gives you your own money back. Calls it a dividend, and the share price declines by the amount distributed. Every one of those mechanisms produces a high yield number on the screen and a different kind of damage underneath it that most investors never trace back to the original decision. The rule that would have protected Jordan is simple and takes 30 seconds to apply to any fund you are considering. Look at the 5-year total return, not the yield. Total return is price appreciation plus dividends reinvested. If a fund is yielding 11%, but its 5-year total return is 6%, the yield is not adding value. It is rearranging value. You are collecting income with one hand while losing an equivalent amount of appreciation with the other. A fund yielding 3% with a 5-year total return of 12% is outperforming the 11% yielder by 6 percentage points a year. Over 10 years on a $10,000 investment, that difference is roughly $28,000 in additional wealth. Jordan figured this out in 2023 when he finally pulled up the total return chart and did the comparison Kevin had done 4 years earlier in the break room. He is not angry about it. He made real income. Nothing blew up. But he also knows that if he had clicked one more time before buying, he would have $40,000 more in his account today and a dividend that was still growing instead of one that had been flat for 3 years. The yield number was real. It was just telling him the wrong story about what the fund was actually doing. Kevin still holds SCHD. His yield on cost is now 5.8%. In 2 more years, it will likely cross 7% on cost, assuming the fund maintains its historical dividend growth rate. He will be collecting more annual income than Jordan on a smaller original investment from a portfolio that is worth more and still growing. The only thing Kevin did differently was spend 30 extra seconds looking at a price chart before he bought. That 30 seconds is now worth roughly $40,000 and counting.